Good day. My name is Dr.Suresh Head of Rates and FX Strategy at RHB Group Treasury Global Markets. In this segment of the podcast, we shall discuss some key features for markets ahead. The World Bank forecasts that 92.9% of countries will fall into recession this year, with the figure dropping back below 20% in 2021. However, any recovery will depend on how quickly governments can ease lockdown restrictions and increase spending, which may prove difficult if there's a second wave of coronavirus. The risk is the global economy gets back into a lull period if infection rates surpass the improvement in economic activity that could induce two outcomes, namely policymakers injecting more stimulus programs, and secondly, if there's a total shutdown in economic activity given movement control orders by respective nations. If the latter outcome plays out, there is greater risk of the global economy faltering in the final quarter of the year, dragging growth projections for the year to the lower end of the forecast scale. For markets, that should point towards more easing of monetary policy conditions and expansionary fiscal policy, though the risk of debt levels rising and currency markets being forced to absorb this risk premium will be expected. Markets are repricing the US presidential election risk. A higher capital gains tax that could accompany a win by Democrat presidential nominee Joe Biden is also emerging as a potential counterweight to this year's powerful rally in stocks. Biden has taxing capital gains and dividends as ordinary income, which would increase the tax rate from 20% to 39.6% for individuals and couples earning over $1 million, the highest tax bracket. That policy, which would likely be easier to enact if Democrats also win the Senate and retain control of the House, may push some market players to lock in gains ahead of December if Biden emerges the winner. The US unemployment rate fell to 7.9% in September from 8.4% in August, but President Donald Trump's announcement on Friday that he had tested positive for the novel coronavirus pushes that number into the background. Voters may be weighing news related to the virus a bit more than the economic data currently. Monthly job gains slowed. Overall, of the 22 million jobs lost since February, the economy has recouped about half. The report counted more than 12 million Americans among the unemployed. The jobless rate was nearly as high as it is now when voters picked Jimmy Carter, a Democrat, over Republican President Gerald Ford in 1976, when Carter lost to Republican challenger Ronald Reagan in 1980, and when Democrat Arkansas Governor Bill Clinton ousted Republican President George Bush in 1992. It was also nearly as high when Americans re-elected Democrat President Barack Obama in 2012. Speculators reduced their net short dollar positions in the latest week, according to Commodity Futures Trading Commission data. The value of the net short dollar was $30.47 billion in the week ended September 29, compared with the net short of $33.6 billion the previous week. US net shorts hit a more than 9-year high of $33.68 billion in late August. In a broader measure of dollar positioning that includes net contracts on the New Zealand dollar, Brazilian real, Mexican peso, and the Russian ruble, the dollar posted a net short position of $30.40 billion, up from net shorts of $33.98 billion the week before. For Asian currency market, there are two probable outcomes. President Trump remains in office, which will be seen as a negative for trade and increased trade friction with China. Year after year, decade after decade, trade deficit upon trade deficit, Trump and key members of his administration see the trade deficit as inherently bad and used a variety of tariff and trade restrictions as part of a pledge to eliminate it. The deficit tends to ebb and flow with the economy and showed no signs of dissipating even before the pandemic. Alternatively, a Biden victory will mean less trade friction with China and an overall positive market sentiment for Asia in general. Dollar ringgit and dollar sing, the significant levels to be eyed are 4.10 and 1.35. Given the fact China will lead the global economy in 2021, we expect both these currencies to remain steadfast on an appreciation path, aided by increased exports as well as supported by recovery in private consumption. China will lead the global economic recovery in this post-COVID-19 growth cycle. The currency has been on an appreciation trend, and with 6.70 as the next major support line for the currency, the relative growth plays between China and the rest of the world plays in favor of the Chinese yuan. Thank you for listening to this podcast. I hope it has been beneficial in your decision making.